Good afternoon. My name is Don Vivrette. I want to welcome you to It's Your Estate. Session today is on retirement account planning. I hope you've had a good time and have survived the fires in the area and all the other things going on around us, but wanted to welcome you in. As we've done before, here's basically the process we've gone through. I know that this seems like a repeat, but honestly, each time we get a question of where are the materials. So in the confirmation and the reminder, the emails you get at the bottom of the screen, it's at the bottom of the email, it says materials at itsyourmoneyandestate.org, and it will look like that when you go into it. And when you do, that will allow you then to select which one do you want to be, how do you want to go through this, do you want money or estate? The video for the prior weeks will always be the first video because there are some other ones that do show up. So that will show up, but all of the material is there. And also today there is a handout for Chapman University, which will be the charity of choice for the day. But I want to remind you that there is material there for them that they have provided to us. So speaking of sponsors, people have asked where we can find out more, where you can find out more information. The various charities are listed under sponsors on that same website. That will take you to their website and get you additional information. Today, as I said, we're doing retirement planning. So that's the subject as we go through today. Next week will be Pete and Trevor are going to do trustee and executor duties, which should be delightful to go through. These are the locations we're normally at. We want to give them a thank you for having been there in the past. And as I keep saying, please let us all be there in person going forward. So that's where we are in terms of those. The participating nonprofits that we have had, here's the list of all of them. Again, Chapman, shout out to them, 10 years for being a sponsor, and they are today's charity that you will see in just a minute. So just wanted to let you know, these are the whole group that we have had along the time. As I said, Chapman University is the sponsor of choice today. And so let me go over here and get us a video. And I need to do this. I talk to myself when I do things, I apologize. I'm a noisy person.
Hello, I'm David Moore.
And I'm Lindsay Jacobs.
We work for Chapman University, a proud sponsor of the It's Your Money and It's Your Estate series since 2010. One of the reasons that we sponsor the series is because we know the information is so good. The second part is that we really know that in order for people to be philanthropic, they need to have a good understanding of their own financial assets and where they stand, long and short term both, so that they can plan for the future.
We would like to give you some insights into the university. We opened our doors on March 4th, 1861, the day that Abraham Lincoln was inaugurated as President of the United States. While our founders had actually approved plans approximately a year prior, they intentionally waited for the date of Lincoln's inauguration to make a clear and firm statement about their belief in equality.
Chapman is still known for its commitment to equality and inclusion. We're also now considered one of the fastest rising stars in higher education.
In 2019, we made an important move from regional universities ranking to national universities ranking in the U.S. News and World Report Best College Rankings. And this put us alongside institutions like Harvard, Stanford, MIT, and Caltech.
That same year, Chapman University achieved an important milestone as we were recognized with the R2 status in the Carnegie classification of institutions of higher education. That R2 status recognition is a confirmation of the research activity that's happening at Chapman University, as well as what's happening at the graduate and doctoral programs at the university and professional programs too. Additionally, our Phi Beta Kappa Honor Society membership confirms our deep commitment to the liberal arts.
I like to share that our Ardrose School of Business and Economics is the highest nationally ranked undergraduate business school in the state of California. Additionally, our Dodge College for Film and Media Arts is ranked number 6 in the nation. And we have many other nationally recognized programs in health sciences, economic science, computer sciences, film production, entrepreneurial studies, and so many more areas.
Our faculty includes a Nobel laureate in economics, a National Medal of Science in Physics recipient, as well as Fulbright and MacArthur Fellows, and many Oscar and Emmy recipients.
And last fall, we opened our School of Engineering in order to meet local, regional, and national shortages. With its Grand Challenges initiative, our Fowler School of Engineering is reinventing engineering education. Our students are tackling some of the most vexing challenges for our society from almost their very first day.
In addition to our campus in Orange, we also have our graduate level Rinker Health Science campus located in Irvine, California. That specialized campus is home to our Doctor of Physical Therapy, our School of Pharmacy program, our Physician's Assistant program, and many other programs that meet healthcare needs in the community. We opened that campus not only because of the desires of our students, but because we understood the urgent need in the community to address healthcare. With an enrollment of nearly 10,000, Chapman University attracts students from around the world and provides them with an opportunity to dream big. We are blessed with wonderful friends and donors who support the university and become our advocates and create these opportunities for our students.
As a graduate of the class of 2009, I know that my scholarships enabled me to attend Chapman, especially during my last 2 years in which we entered the Great Recession. I am forever grateful and deeply honored to be a living part of our generous Chapman family members' legacy. Today, our bright, deserving, talented students are facing an entirely new set of difficulties with COVID-19. And just like they did when I was an undergraduate student, our Chapman supporters have stepped up to keep the Chapman experience alive by ensuring that our students have scholarships and a safe and well-equipped campus for the future.
Our supporters recognize that their generosity is an investment in the future through healthcare, science, technology, engineering, mathematics, business, entrepreneurship. There's so many ways that it really has an impact, and this makes all the difference.
And they appreciate that Chapman helps its graduates establish an ethical foundation on which they can build their lives and their careers as they become leaders in the global community.
If you'd like to learn more about Chapman University and how you can make a meaningful difference for others, please let us know. We'd love to talk with you.
Probably that's going to stop in a moment. There we go. Okay.
Hello, Don.
Hello, Pete. I need to get rid of something here. For just, well, hang on. Yes, I need to do that. Because yet again, I've managed to lose my mouse. Horrible thing to have happen to you. Okay,
Yes.
so Pete's going to take us forward. I'm going to go and read the question and answers, and we'll come back and ask questions as we go along. Otherwise, I will see you all later.
Okay, thank you, Don. And thank you, Chapman University. David and Lindsay are absolutely as nice in person as you see, as you saw them on the video. And I know for a fact they weren't around when Abraham Lincoln, when the school started. And I didn't realize that the school had that large of a history, but that university is absolutely super. If you get a chance to, David has, and Lindsay they have a golf cart, and they'll take you around the entire campus. And the campus is really fun to go through because they have these statues with quotes from different individuals throughout history. And their film school is wonderful. It's bigger and more prominent now than SC. And where they're located is kind of nice too. And our presenter today, Michael Simon. Michael, why don't you put up your outline?
Absolutely.
And we will get going. So nice not to have a commercial from a corporate and we get to learn a little bit about some of the charities in the community. There are so many wonderful ones. Let's see. Okay, as we do all of our presenters, well, before I introduce you, Michael, I'm just going to do a brief 5-minute kind of where we've been.
Okay.
We've taken a kind of a quiz in the first session. Second session, we talked about the estate planning basics, about how important title is, how important cost basis is. You need to know your present market value. And then the following that, we talked about the durable power of attorney, which we'll talk a little bit about today as well, and the advanced healthcare directive. And then we went into the living trust, and we're going to talk a little bit about that as well, because this has a lot to do with your retirement planning. And then again, we talked about the charitable aspects, and believe it or not, you're going to learn some new stuff in this area again today. So we have one of the best presenters here in Orange County who's an attorney in this area. Very, very few attorneys understand retirement assets. And because usually the attorney doesn't really need to see your beneficiary designation forms in order to draft, start my video. Okay. Technical difficulties. Let's see. Here we go. Don, am I starting now?
You're on now. You were on, you went off, you went on, you went off. And at the moment, don't touch the lower left-hand corner of your screen.
Okay, thank you. So today it's going to be, you're going to have one of the best presentations and someone who really focuses in on retirement plans. So Michael, what's your master's or other advanced degree in?
I have a Juris Doctor degree from Chapman University, actually.
And how long have you been in practice?
About 20 years.
And of those 20 years, how many years have you been in the practice of estate planning?
That's all that we practice, doing estate planning as well as probate and trust administrations.
Okay. And so you do practice, you have a license to practice. Again, I recommend highly that you look up the attorney that you're planning on going to. You'll get us Michael's license number. And the good news is that he has 0 disciplinary actions.
That's right.
How do you charge, Michael?
Well, for estate planning, most of the time we charge a flat fee. And for a standard estate plan, which would include a will, a trust, a power of attorney, and a healthcare directive, we charge about $2,800 to $3,200 for a married couple. But we like to pack a lot of value into that number. And what I mean by that is that not only do we do the documents for you, but we also take care of filing a deed for you and preparing it. That goes by a courier to the county recorder. We also take care of all of the attorney time in that pricing. And we like to spend a lot of time with our clients to draft a very, very idiosyncratic document. But most importantly, as you mentioned, we also spend a lot of time on taking care of beneficiary designations. And so in the process, we do help our clients filling out these beneficiary designations, which is going to be a large part of our topic of discussion today. For a single individual, it would run about $2,400 to $2,700. And one caveat, obviously, this is for a standard plan. If we do have more complicated situations with blended families, disinherited children, and other complexities, the prices can go up. But for most of us, we fall into that range.
Okay. And if you worked on an hourly basis, what is your hourly rate?
$425 an hour.
And do you offer any kind of free or complimentary initial conversation or consultation?
I do. I'm happy to speak with potential clients to look over their existing plan, or new clients who are putting a plan together for 30 minutes, and I do that at no charge.
Okay. I think that's all on compensation. You're not associated with anyone who sells annuities or insurance that gives you kickbacks?
That's correct. I'm not.
Okay. So the only thing you practice in is the estate planning area.
That's right.
Okay, let's get going.
Okay. Well, I'm excited to be here. I've got a great presentation for you, packed with a lot of really useful information, and quite frankly, timely. We've had a lot of changes in the law, and so this presentation is probably more important than in previous years. So I think everybody's going to get something out of the presentation today. I will be going through all of my slides on the presentation, as you see, and I just wanted to let you know, if you're new to Zoom, you can touch the view button on your Zoom if you want to change the way that the presentation appears. So if you need to see it in a different light, feel free to move that around on your own screen to see it better. Now, what we're going to do here and what we're going to learn here is I'm going to teach you about the latest rules that affect retirement accounts. And that includes the brand new Secure Act that was enacted at the end of last year, as well as the CARES Act, which was enacted in March of this year. So we're going to cover all that, and I built that into my presentation. And whenever there's a new rule, I'll make sure I let you know. We're also going to talk about how we calculate your required minimum distributions, sometimes known as RMDs. And if you don't know what an RMD is, perfect. You're in the right place, because we're going to talk about it today. We're also going to cover the options for choosing beneficiaries for these retirement accounts. We're going to talk about whether the stretch is dead. And if you don't know what the stretch is, or whether it's alive or dead, you're again in the right place, because we're going to talk about it today. And lastly, we're going to cover Roth IRAs, who are governed by a different set of rules, but we'll save those to the end. Now, a little vocabulary before we start getting into the material of my presentation. And I want to tell you that when I use the words retirement accounts, what I mean is your IRA or your 401k. Again, if I use the word retirement accounts, it includes 403bs and KIOs and pensions and all those retirement accounts. It doesn't include Roth IRAs. Now, why do we care about these retirement accounts? Again, your 401k and your IRAs. The reason is that the contributions that we make to these plans during our lifetime, we get an immediate tax break. So if you made $50,000 worth of income and you were able to put $5,000 into a deductible IRA account, we get a $5,000 tax break and only have to pay taxes on the $45,000. So we get this immediate tax break. Now, in that area, we have our first introduction to the Secure Act, and the Secure Act did something interesting. This is, again, the new legislation regarding these retirement accounts, and it removed the age limitation for contributing to IRA accounts. The old rule was that you had to basically stop contributing when you were 70 and a half, but now you can continue on as long as there's no age cap, as long as you have earned income. So in addition to the contributions, the other reason we care about these accounts is that the contributions in the accounts get to grow tax deferred. And what that means is that no income tax or capital gains tax is paid on the earnings of that money inside this retirement account. And this creates a very significant potential for compounding the money and growing it faster than we would in a regular taxable account. Now, Pete, you may know the answer to this, but does anyone know how much money is in retirement accounts as of 2020? Take a guess, Pete.
100 billion?
100 billion. So you're ready for this. The number for 2020 is $31 trillion. That's with a T. There's $31 trillion inside retirement accounts right now. That's up $20 trillion from the year 2000 and up $10 trillion from the year 2020. So it is an incredible amount of money that is sitting in these retirement accounts.
Wow.
So what about Uncle Sam and all this money that's sitting there in the retirement accounts? As I've told you, all the money inside these accounts are what we call pre-tax dollars. Your contributions that you put in, as well as the money that's earned in these accounts, all have not been taxed. So I guess my question is, do you think the IRS wants a piece of this action? And of course, the answer is yes. And the question is also, if you pass away, do they still going to tax all this money? And the answer is yes again. And in fact, the Secure Act may have sped up the taxation of this money. Natalie Kote, which is one of our national recognized experts in retirement accounts, has indicated that there's going to be about $16 billion that are extracted from retirement accounts because of the Secure Act and the changes that it made. And this money will be used to pay offsets in other parts of the legislation. But as you see through the presentation, you'll see that the Secure Act has had a really strong effect and will cause higher taxation for some of us and our beneficiaries. So the big takeaway from this slide is that these accounts are not tax-free accounts. They are only tax deferred. And as we see through this presentation, generally the IRS is going to get their share one way or another. Now, the last thing I want to talk about before I get into some of the detailed material is that these retirement accounts are a really important part of the estate planning process. But sometimes they're our largest asset. I have clients who have larger retirement accounts than in the value of their home. And so it's important, but it's often missed and overlooked in the estate planning process, as Pete mentioned. People get focused on doing their wills and their trusts, their powers of attorney and healthcare directive, and they forget about their retirement account beneficiary designations. Again, we're going to talk about those designations shortly. So make sure when you're doing your estate planning, I think this is the fifth pillar, not only the will, the trust, the power of attorney and healthcare directive, but make sure you do your beneficiary designations and address these retirement accounts. So the first part of my presentation is what I call rules during life. And so these are the rules that we deal with for you while you are the account holder of these retirement accounts, again, 401ks, IRAs, and 403bs, etc. So the first rule that I want to talk about is that unless an exception applies, if you withdraw this money before you are age 59 and a half, again, that's the money inside these retirement accounts, there is a 12.5% penalty. That's 10% state and 2.5% California. It's called an early withdrawal penalty, but that's not all, because remember, we haven't paid tax on this money. No income tax has been paid on the assets. So for example, if you took out $100,000 and maybe you're in the 30% tax bracket, you've got 30% off the top there, plus another, say 10% for state taxes, and then another 12.5% for penalties that can push you above 50%. Now, the new rule under the CARES Act, it is the coronavirus-related withdrawals of up to $100,000. So this is sort of our first introduction to the CARES Act. And what it did is, first, it said that if you do need to make withdrawals and you are under the age of 59 and a half, if it is a coronavirus-related withdrawal, you can pay the tax over 3 years, or you can put it back over the next 3 years. And there will be no penalty, that 12.5% cumulative penalty. So that can be avoided under this relief provided under the CARES Act. Now, after the age of 59 and a half, but before the age of 72, and we're going to talk about that in a second, because remember, the rule used to be 70 and a half, but between 59 and a half and now age 72, you're able to withdraw money from these accounts, but you're not required to do so. It's optional. If you do pull the money out, there is no penalty, of course, but you do have to pay the regular income tax. You get something called a 1099-R, and the income that the withdrawal from these accounts get recorded on your tax return using this 1099-R. And this is where it starts to get interesting. Basically, starting at the age of 72, and again, the rule used to be 7.5, but the IRS now requires you at age 72 to start withdrawing or distributing part of these retirement accounts each year. Now, as I mentioned, this date that we begin, the required beginning date, is in the year you turn age 72. The old rule was 70.5. And so for those of us who have not started yet, we don't have to start worrying about these RMDs until the year we turn age 72. Now, as I mentioned, these are referred to as RMDs for shorthand. Of course, there's no penalties to withdrawal now because you're over 59.5, but as always, it's still subject to income tax. And to best understand what these RMDs are all about is that the IRS is really just saying you have had a tax break long enough. We've let you defer the income tax on this account long enough, and we are going to force you to take out a little bit each year for the sole purpose of the IRS collecting the tax on it. That's why it's a required minimum distribution. The IRS is simply forcing you to withdraw it so we can get a little bit of tax. So a little bit more about these RMDs. With limited exception, as we mentioned, you start in the year you turn 72. Now, part of the CARES Act, again, this, sorry to make this a little complicated, but the CARES Act changed some of the rules for RMDs for the year. In particular, it excused or removed the requirement for anyone to make RMDs or required minimum distributions for the 2020. And I know this has been big news and everyone knows about it, but keep in mind, anyone who has an RMD requirement this year, it doesn't have to come out. Now, you can still withdraw the money, but you don't have to do it. There's an excuse for 2020. Now, generally, the RMDs or required minimum distributions are required to be withdrawn each year by December 31st. But there is a special first year rule for those of us who are in the first year of required minimum distributions, and allows you to delay your distribution until April 1st of the following year. So let's pretend that you're turning 72 in 2021. We'll presume that there are no law changes and that you're required to do your first year distribution. You technically have until April 1st of 2022 to withdraw that money because it is your first year distribution. But be careful, this is a little bit of a tax trap. And the reason I say that is that even though you do your 2021 distribution in 2022, it doesn't excuse you from your 2022 distribution, which means you're going to have two distributions in the same year, and we call that bunching of income. And sometimes that will push you into a higher tax bracket, cause higher taxation of Social Security and other negative tax consequences. So run the numbers on this. Most of our clients find that it isn't advantageous to take advantage of this first year rule in most cases. Also, some other rules about required minimum distributions is you could always take more. So once we do and calculate your required minimum distribution, if it's $5,000 and you decide to take out $10,000 in that year, no problem, but you don't get any credit or carry forward into the following years. And just to give you a sense about how serious the IRS is about this required minimum distributions, there is a 50%, that's 50% penalty on money that is left in the account. So the IRS is pretty serious about this. Any idea that you might be able to have some great investment that has some great return, it's pretty hard to clear the 50% penalty. So we better abide by these rules.
Michael, would you recommend that when somebody wants to take out more than their required minimum, that they kind of check with their CPA and understand their income tax bracket?
Yes, and I think what you're referring to is that there may be some years where maybe you have very little income where it might make more sense when we run the numbers to take out more during a particular year because we may not get into the next tax bracket, and we can sort of manage the tax bracket. So it's definitely worth talking to a financial advisor or a CPA, especially if you have significant retirement accounts and the required minimum distribution is a large amount.
Thank you, Michael.
Now let's talk about how we calculate this required minimum distribution. Now, the good news is that most banks and brokerage firms do the calculation for you, and they simply send you a letter now in the year that you turn 72.5. But we can do the calculation ourselves, and I'm going to show you how we do it. We use a special IRS table, which is available, and I'll show you where to get it in just a second. We do have to calculate this every single year, but let me show you how it works. So this is the RMD calculation. It's quite simple. You take the prior year balance of your retirement account, I divide it by a life expectancy divisor that I get from a table, which I'll show you in just a second. And that gets us our required minimum distribution. So I'm going to use a hypothetical for next year, and we're going to use age 72. Our table, which is called a uniform table, and this is the new uniform table, which I'll explain in just a second, but the new factor is 27.3. So we take that, and I'm going to assume that we have a ending balance of 2020 on December 31st of $100,000 for my hypothetical. I plug in my 27.3 for a 72-year-old, and the IRS is telling us we need to withdraw $3,663 from our retirement account. And that's all there is to it.
Michael?
Now,
If under in the 2020 rule means that I don't have to take out a required minimum distribution.
that is correct.
But what if I did in February of this year, I took it out, my required distribution, my RMD, can I put it back in?
Well, the answer is yes and no. There were some rules earlier this year that extended the period to return the money, but I believe those periods of time have now ended to return the rollover or to put the money back in the accounts.
Okay, so they should check with the CPA just to make sure.
Absolutely.
Okay.
Now, that life expectancy divisor that I showed you was from what's called the uniform table. And most of us use this uniform table unless we have a spouse that is younger, 10 years younger than we are. Now, the IRS, just to make it fun and exciting for all of us taxpayers, also proposed new tables for us, this new uniform table being one of them, on November 7th of last year. Now, the tables, the uniform table isn't a big change, and you can see the table. I'll show it to you in just a second, but it's in fact a little bit more generous than the previous table. They are available in the IRS publication 590, or you'll see in my presentation, I have the uniform table here. And this table is customized and it has a category which is titled RMD as a percentage of account balance. And the reason I like this table is I want to show you really, quite frankly, how generous, and I use that term in quotations, the IRS is regarding how much money to be withdrawn from the accounts. So for example, you see that age 72 in our example, our factor was 27.3, and that equates to really the IRS asking you to withdraw 3.67%. That's a pretty small percentage. I'm going to jump up to age 80. Our factor is 20.2. So now the IRS is asking you to withdraw for your required minimum distribution 4.96%. That's still a pretty relatively low amount. I have many clients who may have earnings and or gains in their portfolios that may be greater than that 4.96% amount. So these rules are somewhat generous. Prior to 2002, we had much more onerous required minimum distribution rules, but under these schedules, they're pretty lenient. Obviously, it gets a little less lenient, Pete, if we make it to 120, and then your divisor is 2.
Is there anybody ever lived 120? I've heard 116, but I'm really excited about the fact when you turn 90 that you got a good 12 years left on average.
That's right. Well, and that is one thing I should mention is those factors here are supposedly what your life expectancy is at that age. So as Pete's mentioning, if you make it to 90, the IRS says you got 12.1 more years.
I'm excited about that.
One other rule that I want to talk about regarding lifetime rules is that, and RMDs, is that if you have more than one IRA account, your required minimum distribution can be calculated separately for each account, and then you could take it out of one account. Now, it's important, this rule only applies to IRAs, not 401ks and other types of accounts. So, but if you had 2 IRAs and one was fully invested in stocks and other investments that you didn't want to disturb, and another IRA that had cash in it, you could calculate your RMDs for both of the accounts, then put those 2 together and make the 2 RMDs or the cumulative RMD out of the one cash account and not disturb the other one. So this can be a handy rule for some time in some cases. The next topic I want to talk about regarding rules during life is our qualified
Michael?
charitable
Michael?
distribution. Yeah,
Michael, can we go back up one?
sure.
What if we have an example where I have my own IRA, but I also have an inherited IRA? That the inherited would not roll into my personal one. It would remain separate. So in your example here, if you have more than one, then you could take the RMD through having two separate IRAs. Yes?
I'm not sure I understand your question. Here's my take on it. What I think is that inherited IRAs, I don't think you can mix those RMDs with traditional IRAs. And
Right.
so I was more thinking about two traditional IRAs. I'm not sure that you can take your inherited RMD out of a traditional IRA. Is that
But
what
it
you're
would
talking
remain as a separate account, and then you
Yeah.
have to find out about the RMD side.
Yes.
Right.
Good. Okay. Thank you.
Sure. So back to qualified charitable distributions. Now, this is a pretty handy rule. And what the rule allows is that if a taxpayer wants to distribute or withdraw money from their IRA and give it directly to a charity, you don't have to count that income on your tax return. It gets excluded. And again, this is called the qualified charitable distribution rule. It is a rule that is now permanent. Congress was monkeying around with it for a decade, repealing it, putting it back, but it is now permanent and it is part of the law. And I think it deserves a little more consideration under the new tax laws that we're under right now, as I'll explain in a moment. And the best way to understand this qualified charitable distribution rule is to first understand what it's like if we don't have the rule. And the way that it worked is that you would make a withdrawal from your IRA account and you would give it to a charity, but you would have to count that income on your tax return. But the hope is because you gave it to a charity that you would have an offsetting charitable deduction. But it always didn't work out that way, in particular for people who take the standard deduction on their income tax return. When we take our standard deduction, we don't get any charitable deduction. So we would have to accept the income on our tax return and get no corresponding charitable deduction if we have a standard deduction. And again, this is what I was referring to a moment ago. This is even more important now because of the increased size of the standard deduction. Many of us are not itemizing anymore. And without the new this qualified charitable distribution rule, we would have a problem. There were other problems that it caused, higher taxation of Social Security, Medicare, affecting certain tax breaks and deductions related to your AGI. But although all that is solved, and what I mean by that is that the qualified charitable distribution rule now solves those problems, because if we do it under this rule and have the money sent from our IRA to the charity, we don't have to account it on our tax return, and all those problems in the previous slide are solved. And interestingly enough, and maybe as important, is that even though we don't count it as income on our tax return, it still satisfies our required minimum distribution for the year. So let's think about that for a second. Let's say that you normally give $5,000 in December to Chapman University as a charitable donation. You write that out of your checking account. Why not do it out of your IRA account? You could take the money out of the IRA account. It wouldn't count as income, and it would satisfy or partially satisfy your required minimum distribution for the year. So it's a real win-win-win.
So for anyone who's considering a charitable donation and they have an IRA account, they should first look at their IRA account to make that donation.
It is certainly a very tax efficient way to do it. Yeah.
Yeah. The question also is that most people get this confused. They not only want not to take it into income, but they also want to do it as a deduction. Can you take both?
No. So if you don't count it as income, there is no charitable deduction.
And what is more beneficial, is to not take it in as income or to take the deduction?
Well, in most cases, it's not taking it or excluding it from income is better than the charitable deduction.
Yes, much better.
Yeah. Now, there are some rules about this, and this is a little bit confusing, but you can do up to $100,000. Of course, you can do less. You can do $100 or even $1,000. But this is where it gets a little confusing. When they changed the rules this year, they didn't change the age requirement for the qualified charitable distribution rules. So people can take advantage of this at the age of 70.5, not 72. You do have to make these distributions directly to the charity. But here's a little wrinkle in here that we have to think through, and that is that if you make deductible contributions to your IRA after the age of 7.5, the IRS is going to make you use up those charitable contributions before they allow you to use the QCD. And so this is supposed to be a way to prevent some abuse. And the real takeaway from this is that if you've made deductible contributions after the age of 7.5, then you got to talk to your accountant before you start looking at the QCD or the qualified charitable distribution. Okay.
It's a little confusing, but yes.
Yeah.
One thing before we move on, if somebody has a 401k, has an IRA, and they have to take out the required minimum distribution, do you combine the value of both?
Do you combine the value of the IRA and the 401k?
Correct.
The answer is no. Those accounts have to be treated separately.
But
And
they're
is
both
there
subject.
a required minimum on a 401k? I don't think so.
Can you repeat the question, Pete?
Is there a requirement for an RMD on a 401k?
Yes, I thought you were asking whether you could take them out of the same account.
Yeah, it's two different questions.
Okay, yeah, so there's an RMD on all the retirement accounts, 401ks, 403bs, etc. But I thought you were asking, could we take a 401k distribution out of IRA? And the answer is no.
Okay, I'm going to follow that up, and one more question is that once you're retired and you still have a 401k, should you leave it in the 401k, or should you move that account roll it over into an IRA account?
Well, that's a good question, and I'm going to give you the best lawyer answer I can, which is it depends.
Yes.
So leaving it out of 401k after you retire instead of rolling over into an IRA has one advantage, and that is that those 401ks are governed by a federal law called ERISA, and you can get some higher levels of creditor protection inside those accounts. So having said that, a lot of people are not concerned with that, and they are able to or prefer to take their 401k and roll it over into an IRA. And this provides a lot of flexibility, not only a larger pool of investments to choose from, but also better rules for us regarding required, post-death distributions and things like that. So a lot of people, even though there might be higher creditor protection, they like to roll it over into an IRA to get the more flexibility.
Okay, let's go to the next slide.
So this next part of this presentation is about choosing beneficiaries and the rules after death. And ladies and gentlemen, if you have a cappuccino machine or espresso machine, this would be a good time to pour yourself a shot. The IRS doesn't make this easy on us, and quite frankly, even a little more confusing with the new Secure Act. But what I've done is I've tried to break down these rules into a simple manner, and hopefully I can share this information with you so that we all have a clear understanding. And the way that we're going to start out is going over some basic concepts about choosing beneficiaries and how these accounts are treated after death. And I think if we understand these concepts, it'll be better for us to understanding the rules in this area. The first concept I want to talk about is during your life, you get to pick beneficiaries for your retirement accounts, again, IRAs and 401ks, etc., by completing a beneficiary designation form with the institution that holds that retirement account. Now, it is possible that you can do this online, but our preference is, because we like a paper trail, is to use the form itself. You would get that form from your work if it's a 401k, or from your bank or brokerage firm if it's an IRA or other type account. Now, the good news is once you have properly completed and filed that form, you have what's called a contract to pay on death. And so by filling out this beneficiary designation form, you have avoided probate. There are no probates with a properly completed beneficiary designation form. The other good news is that you can fill these forms out and change them anytime you want. There were some old rules back in pre-2002 where there were limitations on when and how you could change those. Those rules have all been eliminated. So the latest dated beneficiary designation form on file is the one that controls what happens to your retirement accounts. And the third subpoint under this first concept is that the beneficiary designation form is what controls these accounts when you pass away. And this is really important because there's a misconception that if you do your will and your trust, that somehow they will control what happens to these retirement accounts, and it is not true. If you have a will and trust and you leave everything to your children, but then you have a beneficiary designation saying you've left your IRA to your neighbor, the beneficiary designation supersedes your will and trust, and those assets would go to your neighbor. So it's very important that these forms be completed in conjunction with the rest of your estate plan.
So should people make at least a photocopy of these forms and keep it with their estate planning documents?
Well, I prefer actually, yes, doing a photocopy is great, but I think taking one step further is that generally when you submit a beneficiary designation form, you should get a confirmation letter from your work or your institution that holds your IRA and other retirement account confirming that they have received it. If you already have one on file, you can simply call the 800 number for the account and say, can you send me a confirmation letter? That's even more preferable than a photocopy because it confirms that they've actually received it.
Good idea.
Okay. The second concept is that after death, a designated beneficiary, again, the one that you've appointed on that form, can continue to defer the income tax until the money is withdrawn. Now, as we find out that that period has now been shortened because of the Secure Act, but the point is that a beneficiary doesn't have to pay the income tax the next day. They are able to defer the income tax until it's actually pulled out of that inherited retirement account. Now, the third concept is that the IRS still wants their share, even though you've passed away, and requires your named beneficiary to withdraw the money from the retirement account for the purposes, again, so that they can collect the money and get some of the tax. So from a tax standpoint, it is likely preferable that our beneficiaries avoid taking a lump sum distribution of all the money from the account a few days after you passed away. And we're going to talk a little more fully about that in a few slides when we're talking about naming beneficiaries. But the reason we don't want them to do that is they will lose the potential tax deferred growth in the account, and they're probably going to pay higher taxes because if they take it out in one lump sum, it may push them into a higher bracket. Now, the fifth concept is generally the strategy is then to try to have the beneficiary's withdrawal period as long as possible. Now, before the Secure Act, we used to be able to do something we called stretching or stretch the account. And we could actually use the beneficiary's own life expectancy and go to a table, and we could literally create decades and decades of tax deferred growth. But unfortunately, the party has somewhat come to an end because of the Secure Act. And the Secure Act eliminates the stretch for retirement accounts inherited after December 31st, 2019. So let me be clear in this area. If you already inherited a retirement account prior to this December 31st date, the rules haven't changed for you. You can continue to stretch it. But if we're going to inherit an account after this date, well, then we are subject to the new Secure rules. And that basically says that with some exception, that we only have 10 years after death to empty that account. And I say we, I mean your designated beneficiary, okay? So this is a really big, dare I say, tectonic change in the way these retirement accounts are now dealt with. And this 10-year limitation will really cause higher taxation for many of our intended beneficiaries on these accounts. Now, there are some, we're going to say something, Pete?
No.
Oh, there are exceptions to this 10-year rule. And, just to make your head spin, these exceptions are called eligible designated beneficiaries. And this special class of people we have designated include a surviving spouse, a child of a taxpayer who owned the account who has not reached the age of majority, a disabled or chronically ill individual, or an individual that is not more than 10 years younger than you. So that special class of beneficiaries can still do the stretch, but everyone else is generally stuck with the 10-year rule. And so with that in mind, the rules and the options for distributing this account is really contingent on who you picked on your beneficiary designation form. And with this in mind, the selection of those beneficiaries on those beneficiary designation form is of great importance, and that's what we're going to talk about now. So I've broken down our choices for filling out these beneficiary designation forms and picking our beneficiaries into 5 categories. And I'm going to call them spouse, children, grandchildren, or other adults, trusts as beneficiaries, charities as beneficiaries, or maybe some or all of the above in a combined manner. So our first option in picking beneficiaries would be looking at a spouse. Now there's a benefit of picking a spouse as a beneficiary on our beneficiary designation form, and that is that the money is immediately available to our spouse. So that's great. As we just talked about, our spouse is one of those specialized beneficiaries, those eligible designated beneficiaries that doesn't fall into the limitation, the 10-year limitation under the Secure Act. But more important than both those rules is that there's a special rule for spouses called the Spousal Rollover Rule, and you may have heard of this. I'm going to give you a hypothetical so you can see how this works. In my example, I have a spouse who has an IRA, and they have filled out their beneficiary designation form and named the spouse. The owner of the IRA, the spouse, passes away, and the surviving spouse then is able to open up a new IRA account and move the deceased spouse's IRA into his or her IRA and treat it as if they had owned the account from the beginning. It becomes his or her own account. And with that being said, then the surviving spouse then can, if they're not under the age of 70, if they are under the age of 72, they don't have to take required minimum distributions. They can name brand new beneficiaries for the account, perhaps younger beneficiaries. And they also get some extra creditor protection based on a Supreme Court case from a number of years ago. So this is really a popular method, and one that's tax efficient to roll over your IRA in a spousal rollover after you're gone into an account for the surviving spouse. Now, there are disadvantages of naming the spouse as a beneficiary. One is that the spouse does have complete control of the money, and that means not only the way that it's spent, but including, as I just mentioned, changing beneficiaries. So if we're concerned about that control, maybe in a situation where you have a blended family or children from a prior marriage relationship that we want to provide for, then it may not be the best solution to name the spouse as a primary beneficiary. The second option for naming beneficiaries is naming a child, grandchildren, or other adult beneficiaries. And that's certainly a possibility. We certainly can name those individuals as beneficiaries of our retirement account. Focusing on children, it is theoretically possible to name a minor child to try to take advantage of that special eligible beneficiary designation status and avoid the 10-year limitation. But this is sort of theoretical because, number one, we never want to name a beneficiary as a minor as a beneficiary retirement account. By doing so, we may create a guardianship where the court has to be involved, because remember, a minor doesn't have a signature. We don't want to have those young kids or young people having full control over the money, etc. So there are real issues with naming a minor beneficiary. But the reason I wanted to mention is that this whole category of special beneficiaries that avoid this 10-year rule is a little illusionary, because it is only until they reach the age of majority. So if you have a 16-year-old child that we named, and although there's some debate about what the age of majority is, let's just say for this example, it's age 18. What that means is that the child only gets the special stretch from 16 to 18, but as soon as they hit majority, they're stuck back into the 10-year rule. So this is, like I said, a little illusionary, but we really don't want to name minor children in any case as a beneficiary.
How about naming minor children in a living trust? Would that be the same, some of the same issues?
Well, we're going to talk about that in the next slide.
Okay, thank you.
So then a possibility, though, is we could name adult children, and that is often sometimes the case where we name the adult children. Now, they are going to be subject to that 10-year secure limitation. Again, that means that they have to withdraw the money over that 10-year period. I do want to say that they don't have to, they can do it any way they want during that 10-year period. They could take it all out in year one, wait till year 10. So there's some flexibility. And during that 10-year period, there are potentially many years of tax deferred growth, so not all is lost. And we can sort of, as you mentioned, Pete, manage the tax brackets for withdrawals. Maybe there's a year where a child doesn't have a whole lot of income, so we're going to take a lot of money out of the retirement account during that year and try to manage the tax brackets to make it as most efficient as possible during that 10-year period. Now, there are disadvantages. This is one of Peter's favorite topics of naming children as a beneficiary. As I mentioned, that if we do name them as outright beneficiaries, we do not want to name a minor child, but we do have to keep in mind that a child may not keep it in there for the 10 years. They may take a lump sum distribution a few days after you've passed away. We could have irresponsible spending and creditor problems when we have a child who is named as an outright beneficiary. Oftentimes, the money in these accounts are the first monies that become available to children. It just takes maybe 5 to 10 days to get a death certificate. And as Peter can attest to, it's amazing how fast a kitchen needs to be remodeled after you've passed away. And these accounts sometimes go right out the door.
Yeah, it's just it's almost the first lump sum that they've ever received in such a large quantity, and they believe it can last for a lot longer than it actually happens.
And so they spend the whole amount, and then they get a tax bill for it.
Yeah, and the tax bill comes the following year in April, and so yeah, you may want to talk to your children about that.
Now, this is the topic that Peter was mentioning. What about naming a trust as a beneficiary? Well, we can name a trust as a beneficiary under the current IRS rules. The trust does have to meet certain criteria and have special provisions regarding retirement accounts, but we definitely can name a trust. And this can provide the missing control that Peter was referencing, because if we name the trust, whoever we name as our trustee becomes in control of the money, and even though and decides how the children can spend it and all those kinds of attributes. So by having a trust as a beneficiary, we can protect the assets from the court's creditors and irresponsible spending. And if the trust is done properly, we can still take advantage of some of the special exemptions from the 10-year rule. For example, we might have a trust for a surviving spouse or chronically ill or disabled beneficiary. So there are lots of options here if the trust is done properly. Now, the disadvantages of naming a trust. Well, the first is that, for example, in a spouse, if we name a trust as a beneficiary, we can't do a spousal rollover, so that rule isn't available. Spouses have to be named individually, not through a trust. And the trust must be drafted with proper provisions to qualify under the Secure Act. So the takeaway, and why I included this in here, is that if you are naming the trust under your existing estate plan and you've named a trust as a beneficiary of a retirement account, it is incumbent on you to have your estate planning attorney take a look at those provisions to see if they need to be changed, because this did change the landscape on how trusts are treated, and the Secure Act had a significant effect on that. There are other disadvantages of naming a trust, even though there are many benefits, but one of the disadvantages is that it is possible that we can pay higher income tax rates if distributions stay inside the trust. And what I mean by that is that trusts have a tax rate that starts, the highest rate starts at $13,000, so a very low number. So if money comes out of an IRA and stays inside of the trust, we're going to be in the highest tax rate as soon as we hit $13,000. The trust can also be, I'm sure as Peter can attest to, administratively complex. The institutions don't know how to deal with them. Your work, your 401k, retirement, what Charles Schwab and Fidelity, Vanguard, it's complexity and it's hard to deal with them. and they also can be expensive. So I like to sort of have the philosophy that Natalie Choate, again, that nationally recognized expert in the industry, says. And then she says, you just have to have a compelling reason to have all of these disadvantages. And oftentimes there is a compelling reason. Maybe we have a child who has a drug problem or a creative spending problem. So we can address it by using a trust, but there are some administrative complexities and expense we have to deal with.
Yeah, and especially if you have a special needs child, if they receive the lump sum, it could knock them out of all of their government benefits. So keep it as simple as possible. And I agree thoroughly that you have to have a compelling reason to use a trust in for your IRA or 401k or 457 plan.
The next category of beneficiaries we could look at for designated beneficiaries for our retirement accounts is a charity, right? As the nice thing about naming a charity is that they don't pay any income tax. So for the last hour, I've been telling you how the IRS is going to get their share. Well, here's one way we can beat the IRS at the game, because when we leave money out of a retirement account to a charity, nobody pays any income tax. Now, this can also reduce estate taxes for those of us who have very significant size estates. But what we find is most of our clients do opposite of what I'm suggesting here. And what I mean by that is that they have their charitable bequests inside of their trust, and they're giving charities monies that have already been taxed, and then they're giving their children the retirement account assets that are all subject to tax. We would prefer to flip that, because we would rather have the charities receive the taxable money and not pay income taxes, and make the children larger beneficiaries of our trust. Any comments on that, Pete?
No, there was a question, Don, regarding the QCD. Can you make a qualified charitable distribution and still have it qualify for 100% of your AGI, or is that completely separate?
Separate.
Separate.
Yeah.
Okay, Don just answered the question.
Okay.
By the way, 95% of trusts that I see leave charity in the trust and the children on the IRA. And it should be reversed. There would be so many benefits. I mean, do you see that as well? I mean, that people name a charity in their trust and then leave the IRAs to their children?
That's right. And in the planning process, a client may come to me with an idea of naming a number of charities inside their trust, but they have a significant IRA. So my suggestion would be, let's look at using the retirement account assets to address their philanthropic desires and have a much better tax income result for everybody.
Yeah, and you can set it up. Let's say, for example, you want 5% of your trust or of your estate to go to charity, and you can literally say, but if you did the beneficiary designation form correctly, you named a charity there, and if it's short of the 5%, then the trust can make up that difference.
Sure. So the fifth class of or category of beneficiaries is usually, using a combination of all these different categories. So we could take a large IRA and have multiple beneficiaries, or break up an IRA, in my example, into one for the spouse, one for a child, one for a trust for a grandchild, and one for a charity. So lots of options here in picking beneficiaries. Now, how do we respond to the Secure Act and this new rule about the 10 years? And there's been a lot of ideas floated, and I thought I'd throw them out there to make sure that you had some ideas. This certainly isn't all inclusive, but here are a couple of ideas in responding to the Secure Act. One is just to accept the taxes for the children and realize, I've had some clients say, well, we always knew we'd our beneficiaries are going to have to pay the taxes and just accept that they're going to have to do that in a 10-year period versus a longer period. As I mentioned, we can try to manage the tax brackets and make it as efficient as possible. Another response to the Secure Act is possibly looking at a charitable remainder trust as a beneficiary of these accounts. We may be able to accomplish lifetime income for our children and other beneficiaries and have the remainder go to trust. And that way we could have some controls on it. And that may work in some circumstances. I've had some clients look at the possibility of buying life insurance to pay the extra tax that they're expecting on their large retirement accounts. I've had some clients look at the possibility of doing what are called Roth conversions, which we'll talk about in a few minutes, by converting some of their regular taxable accounts into the tax-free Roth accounts. A lot of clients are looking more, as we've been talking about, of naming beneficiaries that are charities as a way to sort of address the potential higher taxation under Secure. And of course, the best way that Peter often recommends is spend it. If there isn't anything left because you went on a number of cruises, well, that's another way to eliminate the tax bill for our children.
What a concept. We save this money to use, and we forget because we spend 40, 50 years saving, and we forget that we can spend some of this money for our own pleasure.
Right.
Even gifting to kids, is awesome.
Another area I want to talk about are mistakes that I have seen in my practice, of course, not of my own clients, but new clients and people that are coming to see me. And I want to go over these mistakes in filling out beneficiary designation forms to make sure that none of you make these same mistakes. So looking at mistakes that I've seen in my practice for beneficiary designation forms, the first one is not naming a beneficiary. Unfortunately, I've seen this way too many times. Somebody will come to me and their parents have passed away or a relative and will go to the institution that holds the retirement account and the form's blank, didn't name anyone. And in that case, what that means is if the account is large enough, we're going to have to go to court. We're going to have to go through the full probate process to figure out who that retirement account goes to.
And by the way, I've got one involved right now, and it's riding COVID. And so, we can't get a court hearing. It stays in the IRA, can't distribute it. Probate fees.
Right. And as you're alluding to, the probate process, which I know you've covered in another presentation, is an expensive, burdensome, time-consuming process. But at this point, I mean, when I file a petition in the probate court, it's 9, 10, maybe more months away before I can get my first hearing. And so that's a real challenge to enter the probate court under the COVID sort of nightmare scenario.
Yes.
The second mistake that we see is people with really good intentions. They write the words "my estate," and I've seen this before. And unfortunately, that has no legal significance, and we are back as if it was blank, and we have to go to probate court to determine what my estate is. And I realize people do this with the best intentions, thinking that that would be my closest living relative, but it doesn't work. So please don't write "my estate" in as a beneficiary under your beneficiary designation form. And we've already spoken about this, but again, with best intentions, we want to name generously a child or a grandchild that's a minor as a beneficiary. This doesn't work. As I mentioned, what technically has to happen is, again, because that minor has no legal signature, we have to have an additional court process called a guardianship, where an adult is appointed on behalf of the minor so that they can open a new inherited IRA account. There's annual accountings, legal fees, all kinds of things. So please don't name minors as beneficiaries on your retirement accounts. The next mistake I see is not naming both primary and contingent beneficiaries on our beneficiary designation forms. And what I mean by that is that there are two spaces on these forms. You'll see one is for primary beneficiaries and one is for secondary or contingent beneficiaries. And we want to fill both of them out Unfortunately, life sometimes doesn't go as planned and we might lose our primary beneficiary. We want to have backups. But even if our primary beneficiary survives, we sometimes do something we call post-mortem estate planning. And what that means is that maybe there's a reason why our primary beneficiary doesn't want or need the money, and maybe we want to bypass them. And if we have secondary or contingent beneficiaries, we can work with that and try to end up with a better result. Another mistake is not keeping beneficiary designations up to date. It has happened a number of times where I meet a new client and he or she has their spouse from 3 marriages ago still named as the beneficiary on their 401k plan. Unfortunately, that happens. So we want to make sure that with family changes and changes in life that we update the beneficiary designations. And as Peter mentioned earlier, we want to make sure we keep records of these designations, as I mentioned a few minutes ago, when we file these, and we tell our clients to make sure that they get a letter from each of the institutions that hold their retirement accounts and keep that with their important documents. There's been a lot of changes in this area where we have banks and brokerage firms that have merged and documents have been lost, and we don't want to have a he said, she said. We want to have something from that institution saying they have our beneficiary designation form. And the last mistake is basically what we've been talking about all along here, is that not considering or planning for the income tax issues when we're selecting our beneficiaries. We do have to think that part through. So again, this is a list of mistakes that I hope all of you avoid. Now, the last part of my presentation today is talking about Roth IRAs. Now, there are a number of interesting benefits of Roth IRAs. The first is all that stuff that I spoke of earlier about required minimum distributions are not required during your lifetime for a Roth IRA. In other words, there are no RMDs on Roth IRAs for the account holder. So we don't have to start taking money out when you reach age 72 on these accounts. So that makes it much different than our regular retirement accounts. Now, like the other accounts under the new rule, we can continue to make contributions to these accounts if we have earned income. So if you are earning income, you can continue to contribute to these accounts regardless of your age. And what really makes these accounts different is tax-free growth. And that is not a typographical error. This isn't a deferred account. It is a tax-free account. And what I mean by that is that the money inside these accounts never gets taxed. It's tax-free distributions to you and your beneficiaries. Now, once you pass away, these Roth accounts are subject to the 10-year limitation, meaning they have to be emptied in 10 years, but when they come out tax-free. You can, on Roth IRAs, if you have your spouse as your primary beneficiary, you can roll over your Roth to your surviving spouse, and they can treat it as if it was their account from the beginning, like a regular IRA account. So you might be saying to yourself, well, gosh, that sounds great. I want tax-free growth and all those other benefits. I want to convert my existing IRA account into a Roth IRA account. And we can do that. As I mentioned earlier in the presentation, we can do something called a Roth IRA conversion, and we can convert a traditional IRA into a Roth IRA. Now, everyone is eligible to do this. There used to be some income limitations that only certain people who made less than a certain amount of money could do, but all those limitations have been removed. Anyone is eligible at this point. But here's the kicker, everyone. The third point here is that you've got to pay the income tax on the conversion. So this can be a very expensive proposition. So we need to do careful analysis to see if it makes sense. One point before we start talking about maybe factors that we would consider in doing a Roth conversion, I do want to say that you used to be able to do something called a recharacterization. You could actually do this Roth conversion, and then later you could decide to put it all back if you didn't like the results. But that rule was taken away in 2018, so there are no more recharacterizations. Once you make the decision to do a Roth conversion, you are stuck with the results whether you like it or not. Now, what are the factors that we'd look at in considering doing a Roth conversion? One factor we'd look at is if you expect your income rate to be higher in the future or maybe during retirement, well, then maybe that's a factor that would lead you to do some conversions now at your lower rate. And I should say, this isn't an all or none proposition. You can do part of any IRA account in any amount in multiple years. So there's planning that can be done with these Roth conversions. So one factor again would be if you're going to be in a higher rate or expect to be in a higher rate in the future. Another factor is that you don't think you're going to need the money for living expenses. We want the money to stay in the IRA, the Roth IRA. So we don't want to go to all this trouble, pay all the taxes, and then to have you spend all the money. And that goes hand in hand with the third point, is that we want to make sure your investment time horizon is long enough to benefit from this tax-free growth. Again, we are going to be paying a lot of money here, and we want to make sure that we take advantage of this tax-free benefit in the Roth IRA account. And the second to last point is probably the most important factor to consider when we're looking at a Roth conversion, and that is that you have separate funds to pay for the Roth conversion. Here's what I mean, is that if, let's say you're going to do a $100,000 Roth conversion, and I'm going to hypothetically say your tax bill is $30,000 to do the Roth conversion. We do not want $70,000 to end up in the Roth account. We want $100,000 to end up in the Roth account, and you to use the $30,000 from a checking account or brokerage account so that we can end up with the full amount going over into the Roth. If we do something less or use the retirement account itself to pay for the Roth conversion, the numbers just don't work anymore. And of course, another factor to think about is estate planning and estate tax objectives and looking at Roth conversions. So there are a set of some of the factors you can look at to decide whether a Roth conversion makes sense for you. As Peter always says, we really got to run the numbers on these things to make sense.
Yeah, and this is a great exercise. It's super. Bring these factors, make a photocopy of them, and either bring them to someone like Michael or to your CPA. I just also want to just warn you, most attorneys do not know anything about money. They know the law, but not about money and number crunching and running these kinds of numbers for you. So a CPA would be best unless you have somebody like Michael.
Great. Well, I'm nearing the end of the presentation. One thing I'd like to sort of end with is the thought of possibly jumpstarting your children or grandchildren's retirement fund. And what I mean by that is that if you have a child or grandchild that has earnings, maybe they work at a sandwich shop or a fast food restaurant, and they have earned, let's say, $6,000, they don't have to put their $6,000 into a Roth IRA. You can make a gift into the Roth IRA on their behalf and start their retirement now. Now, this can actually, obviously add up to a significant amount of money and be extremely beneficial. If you're over 59 and a half of the child, all the withdrawals that we talked about of all this money will all be tax-free withdrawals. The money that's accumulated in this Roth account for child or grandchild, if they are under 59 and a half, they can make, there's no taxes or penalties until all the contributions are withdrawn. There are special breaks for college and first-time home purchases out of Roth IRAs. But do remember that the child or the grandchild does have significant control over these once they reach age 18. So we may have the best intentions here to create an amazing nest egg for our children or grandchild, but we don't want them to pull it all out the day they turn age 18. Don't you, Peter, don't you have a story about?
Well, when our son, when he was 7 years old, his grandmother hired him to clean the car, wash the windows, mow the yard, and she gave him close to $100 per hour. And of the $100 per hour, she put $95 into a Roth IRA. $5 she gave him outright, and created a wonderful bond. and always wanted to go to grandma's. And to this day, because it was his earnings that went into that Roth, he still hasn't spent it, and it's still being saved.
Nice.
Yeah, it's we've got lots of questions. So let me know when you're kind of done. And then Don, if you want to read the questions off.
Yeah, and I'll just wrap up by saying, we focused on, the one component of a retirement of the estate plan, and that's retirement of plans. And hopefully after today's presentation, the retirement accounts fit in with the rest of your assets to make one successful estate plan. And I've left about 10 minutes now, and I'm happy to take any questions that are on the table.
Yeah, good. By the way, if we don't get to all of the questions, or somebody has a question later, can they email you with a question? Michael?
Absolutely. My email's on the screen right now. And obviously, if you download the presentation, it's there too.
Okay. Don, you want to start with the questions?
So if I have an IRA or a 401k that I have put in after tax contributions also, how does that come out relative to an RMD or taking the money out?
Yeah, well, when we make what are called non-deductible contributions from into a retirement account, specifically this is somewhat more common with IRAs, making non-deductible contributions to IRAs. When you start pulling them out, the non-deductible part comes out in as a portion of it, and that part isn't subject to taxation. It's like pulling out the principal back from what you contributed. Does that help answer the question?
So do they then give you a statement that said this is taxable, this is not?
Well, some institutions do, but for 401ks, but my experience with the IRAs is that you have to maintain the records yourself. And I can't quite remember. It's like a 5606 nightmare form where you're supposed to keep tracking of what you put in as non-deductible contributions. So it's a real headache.
I know, for instance, on when you do a QCD, if you take your requirement and distribution, they're going to give you the 1099-R. It will say the total amount you received. You need to make sure you keep track of how much of that you gave as a contribution. In our case, what we do is have the check payable to the charity, but come to us. I photocopy it, we mail it to the charity. So now I have a record of this was what was paid, because the charity will not give you, you've made this deduction, because it's already been deducted. It was out of the QCD. Okay.
Yeah, and on that point, back on QCD, some topic that we've discussed before is that sometimes when the check goes directly from the brokerage firm or bank to the charity, they don't have your name on it.
Right,
So
they don't know who it is anyway. Yeah.
Let the charity know that they might be expecting it, so they know it's from you.
That's part of why we have it come to us.
Yeah, and the other thing too is that we believe that a Merrill Lynch or a brokerage firm, the staff understands all the issues involved with a Roth or a regular IRA. They don't. So you need to get some expertise who really understands the rules. Go ahead, Don.
Don, let me interrupt. I just want to clarify something you said. You said the check comes to you, but I think what you mean is that the check made to the charity comes to you.
Yes. Oh yeah. Payable to the charity.
Right.
So it will say, since that charity, and that then comes to us. So we can't cash it, and it is not payable to us. That means we'd be taxed. So very clearly it has to be made out to the charity, and you can have it sent straight to the charity as long as you keep track of, because the brokerage house won't tell you.
Is there a definition of chronically ill?
Yeah.
Yes.
There is. So where would they find that?
They're going to send an email to Michael. Because that might be a longer issue.
There are definitions provided in the Secure Act and references to other parts of the IRS code, which specifically define what it means.
Okay.
All righty.
Can I list on, so my spouse is my primary on a beneficiary statement, and to my descendants who survive per stripes as secondary. Is that okay?
Per stirpies.
Stirpie. Oh, I'm sorry. I can't read. It didn't make sense when I read it. Stirpies.
Right. And so this is sometimes referred to as a class gift. And the challenge, of course, is that, first of all, it may not be permitted by the institution because they want a specific person or name rather than a class of individuals. So that's our first hurdle if you wanted to do this. And the second hurdle is that the institutions, even if they allow it, it is very difficult for them to make that determination of who your descendants are. That's a legal determination. So the bottom line is I don't recommend that people try to do class gifts on beneficiary designations like the ones suggested.
So name specific children.
Right now, having said that, the word that was referenced there was called per stirpes. It's a Latin term, which means they want it to be passed down in some way during the bloodline. So you'll see on many forms, you'll have a per stirpes or per capita box. So you might name your child, adult child, and you might mark per stirpes there, which means that if that child doesn't survive, you want it to go down to their children and or grandchildren, but that has to be thought through, because if we do per stirpes and it ends up going down to grandchildren, they could be very young and we end up with minor beneficiaries.
Good point. Are there restrictions on IRA contribution based on income? In other words, if you file a return married filing jointly versus head of household?
Yes, there are limitations on the contributions, and rather than you can look them up. I have them here, but there are different contribution levels depending on whether you're married, single, etc. They're all available on the internet, which affect your contribution levels.
Don, you want to take the next one?
Okay. Can retirement accounts, Roth IRAs, be rolled over if an adult child is the beneficiary? I think that's going to depend on ages and times.
Can you repeat the question?
Yeah, sure. Can retirement accounts / Roth IRAs be rolled over if an adult child is the beneficiary?
Well, I'm not sure that I understand the question.
In other words, if you have a 25-year-old inherits your Roth IRA,
Yeah.
can that be stretched out over their lifetime?
Well, the answer is under the Secure Act, they have only 10 years.
Right.
Okay. All righty. So Roth IRAs can be rolled over, but the maximum is 10 years.
That's right. And, in some ways, even though that money comes out tax-free out of the Roth IRAs, they still put the 10-year limitation because they want to stop the tax-free account from existing.
Yeah.
Okay.
In talking about a Roth conversion, is there a spreadsheet or something that would help?
I don't have a spreadsheet. There are a number of online applications that you can try to put the numbers in. It is a complex calculation because you do have to run a number of different scenarios and different rates, plus what we call a balancing account to make sure it all works out. And so there are some online. I don't have any specific to recommend, but if this is a significant amount of money, I would suggest that you contact your CPA to run the number for you to get a firm number.
Well worth the time.
I think this one's slightly backwards, but I'll ask it as is. If the beneficiary of an IRA is a living trust, do the rules you gave for the trust beneficiaries apply?
Well, so I'm not sure I understand the question, but yes, we can name a beneficiary, a trust as a beneficiary.
Living
we want
trust?
to make sure we want to make sure that the trust meets the certain criteria.
Okay.
But a trust, and you can use a living trust, but we don't want to use just any living trust. It needs special provisions in it.
Yeah, and the other thing too is that if you do name a living trust and the trustee of that trust doesn't understand some of these rules, it could really cause a lot of issues. So avoid naming a living trust unless you absolutely need to.
Correct.
I think for a matter of timing, I'm going to call a break on what we're asking here. I can't, I'm reading through these real quickly. A lot of these are very specific in terms of situations. So
it says, can you convert part of your traditional IRA to a Roth, or do you have to do 100%, assuming that it just have one IRA account?
Yes, you can do partials.
You could do partials. What's the record keeping when you fund a child or a grandchild's Roth IRA?
What is the record keeping?
Yeah, there's not much. Just make sure.
Right. Well, I suppose you want to ensure that the child had the appropriate amount of earned income that corresponds to your contribution.
Yes. So file a tax return. If you have a savings account for a minor, should I move them into the Roth IRA? You can't. Only if the child has earned income. Yes. Good. how do I download the slides?
Yeah,
Uh,
look at the reminder that you received at the
Yeah.
bottom of the page. It tells you where to get the slides. They're all there. It's the same thing we've had for 6 weeks. I'm sorry. The question is asked every week, and I know that some of you are repeats. So
Okay.
sorry,
When
John.
I send my RMD directly to the charity, does the individual still get a 1099R from Schwab?
Yes.
And the answer is yes. And as Dawn correctly mentioned, unfortunately, they don't designate it as a QCD, so you have to keep that record yourself. I was hoping there'd be a separate code for it, but there isn't apparently.
But there is, however, and I know this only because my wife is slightly older than I am and had her RMD/QCD last year, and we did get a statement that said these are the withdrawals you made and the companies. So a couple of you have referred to the fact that some of the brokerage houses do that, and you are correct, they do. I'm a CPA, and I wanted to make sure I controlled it.
Yeah.
We are after 3 o'clock, and so I'm going to say let's answer those another way. So thank you very much.